Welcome to Subramani. Imagine in a country where inflation is likely to be 6% or 7%, and GSEC is available at about 7% or 7.5%. Somebody comes and offers me about 11.5%, almost close to 12%, because it is 11.5% payable half yearly, in a risk-free investment with zero beta. And what can be better than that, right? So here I am being offered a return which is just fantastic, and it is very useful for me because I need to remove some money from equities. I have enough money in equity, so getting some of the profits into some other fund or getting the dividends into some other fund makes sense. And real estate is not really a great option because I'll have to remove a much bigger chunk than what I want to. So this is a good place to invest, right? Zero risk, absolutely no beta, no, not at all connected to the market. So this is perfectly right for me to invest, right? No, sorry, wrong, because I don't think the same measures of risk like Sharpe ratio and beta apply to private debt. For example, I have investments in private equity, which again has zero beta. There is perhaps a very high Sharpe ratio because of the past returns that they have got, but it doesn't mean there is no risk. These measures of risk which are used for a public listed asset cannot be used for a private asset. So you can't say there is no risk in private equity funding or private debt funding because there is no beta, because there is no correlation to the market, right? And is there risk? Of course there is risk. One day I can get up and find that my money, whatever I put, maybe 25 lakhs in private equity, it's completely gone. The CIO and the CEO got married, and then they just ran away with the money, right? Anything like that can happen. That kind of risk, apart from the market risk and things like that, these things happen in private equity. People don't even realize, because you hear only of success stories saying, if I had invested $10 in Amazon, what it would have become today, right? So the question is not whether there is risk. There was risk when you started, right? So would you have had the guts to sit through the whole exercise? And I don't have the guts to sit through a whole debt exercise of getting 12% return. At least if I put money in real estate or crypto or something like that, there is some chance of an upside. With debt, there is no chance of an upside. Why would I go and put any money in debt? In fact, I don't put any money in debt with a view to getting a greater return. For me, debt is capital preservation. When at a time when I think there is nothing attractive in the market, if I can get 8% nice, good quality return, perhaps post checks about 6.5%, I am not too tempted by looking at the equity market. So unless I can now, if it is 6.5% is what I am going to get in the debt market, and if I can get 10-11% kind of a short return in my mind, then I would look at investing in equity. Today, if I find that the market is overpriced, I may not enter equity markets, but I will definitely not enter this kind of debt which is lending to private parties. They have built up a big book, but I don't want to give any of the numbers, names, the indicative return I have already told you. I am not interested in revealing more because I don't want to hurt them. I don't want to hurt myself by investing. I don't want to hurt them by talking about it and then them suing me for saying, why did you didn't want to invest, you should have just kept quiet. So I'm not interested in naming them, but no, I don't invest in this kind of debt because private credit is today a big thing because there is a shortage of money in the market. The banks don't have enough money to lend, so private credit is a big thing. But I am not interested in private credit simply because I don't understand how it works. I think a lot of the risk is outsourced to accountants, lawyers, etc., maybe credit rating agencies. So one of those companies said, we look at the credit score of the promoter also, the CIBIL score, which is all fine by me, but it's not enough for me to lend money to anybody where I'm getting 5% or 4% over and above the risk-free return, right? So, and this is not just some a debate where should we invest. It's about me putting my money, and the answer is no. My money does not come so cheap, right? By definition, this is high risk because it's private equity. You do not know the lender. You do not know the person to whom you are lending. Right, there is an intermediary who takes money from you and he gives you all the details, but you are still not sure because you have not met that person. And is it worth going and meeting that person for 50 lakhs? Answer is no, there is too much of effort, right? So I would rather go and stick myself into some equity savings fund with a low equity, which means the big portion of it is hedged, and hoping to get 7%, 8% return, maybe after sell it after 1 year and pay 10% tax, or a debt taxation after 4-5 years. I don't mind, but am I taking risk in any of these things? No. Because there is absolutely no risk parameter available. It's just like private equity. If I put 25 lakhs with a friend in a private equity as a level 1 funder, or as an angel, I either have the money or I lose the money. 5 years later, I find that the promoter has not done anything. Maybe every 6 months he keeps telling me something, but end of it is lost, right? So private debt to me is not a very attractive thing. In the US, there are private credit interval funds. That kind of funds could also work, where you could take money in and take money out. Maybe a credit AIF or a credit PMS could work, but a credit fund today makes no sense, simply because the income from that is being taxed in your hands at full rates. So the so-called tax attraction of a debt fund is completely gone. So to say that there is no risk in these funds is wrong. The common measures of risk like Sharpe ratio and beta and all don't apply, because they are not publicly listed. Private debt definitely provides very high income, and definitely helps you diversify your portfolio. The borrowers that incur private debt are hungry for capital, so they have very little choice of what rate of interest to pay. Loans are typically short term, 3 years, 5 years kind of a thing, or less than 5 years also. They play a floating rate. So for you, I mean, when I look at the structure, I think the structure was very good. They pay a floating rate. It is linked to the SBI PLR plus 3%, right? So every 90 days the interest is reset, but I do not know whether the money will come back. So that is the risk that I don't want to run. And because there is no public trading, I cannot get out of it halfway. Like if I put 25 lakhs in a bad fund and I suddenly find my fund has gone to 23 or 20, then I can say, okay, 5 lakhs is the loss that I wish to take. But in a private debt, I think if I put 25 lakhs, I can either get back 25 lakhs with 12% interest, or I get nothing, right? It can be completely wiped out. So to say that there is I think private credit funds aim to achieve a rate of return of about 9-10% to you after tax, which is not a bad rate at all, considering that inflation is 7%. But unfortunately for me, that does not make any great sense, because I think I can get 7% risk-free taxable in a GSEC. Am I willing to get 10-11%? Maybe I get 12% plus I lose 30% tax, so I get about 9%. The gap to me is not attractive at all. I will not put money in that, but it does not mean you shouldn't put your money. Do your due diligence. It's a good way to remove some money from equity capital, from the equity markets, and put it into debt markets. Would I do it? No. Am I recommending it? No. Am I naming the funds which have made me this offer? No. Do I like their processes? Yes. Would I recommend my friends, clients, mother, father to put money in that? No. But it's completely up to you. Do your due diligence and do whatever you want. I don't think everybody listens to all that I say, so do whatever you want, but do your due diligence. Thank you.